Hi, welcome to the Funding Blueprint Unlocking Startup Success, presented by StartHub. I'm Cody Goff, and today you're going to learn about 3 exponential growth characteristics that at least one investor looks for when vetting a startup. Plus, how much focus you should have on things you can control versus things you cannot control, and the answer might surprise you. My voice might also surprise you because I lost it last weekend and I am working on getting it back. So excuse the vocal fry in today's episode, but fortunately my guest does most of the talking, so I hope you can bear with me, and as they say, the show must go on. Anyway, my guest today is Olivia Gaudree, a partner at Fuel Venture Capital and Vice President of Operations. She's responsible for assessing and analyzing investment opportunities that flow through the deal screening process for exponential characteristics with the Fuel Venture Capital investment philosophy, and she oversees the growth metrics of Fuel Venture Capital investments and allocations. Olivia and Fuel Venture Capital are based in Miami. I started a conversation by asking, what's the most obvious exponential growth characteristic that you see in potential investments? And here's what she told me.
Thanks so much, Cody, and so happy to be here today. So it's a great question. And when it comes to potential investments, I think it's important to remember that there's no one size fits all formula. We get a lot of founders who come to us and say, okay, what's the key characteristic that we should be doing? And it really depends because each company is unique. And depending on the stage of the company, their sector, more factors come into play. But for illustrative purposes, I can give you 2 examples of 2 hyper growth or exponential growth characteristics that we look for. And, they may not be the important characteristic for particular companies based on their stage, but these 2 companies are both growth stage companies, and these are characteristics that we identified early on in our investment process. So the first I will highlight is actually one of our later investments, a company called Better, and they're a mobile native B2C sports betting company, and they focus on instant micro betting. And so when we first got introduced to Better through our GP network, we saw that they had a clear advantage over their competition. And the advantage stemmed from their technology, their licensing, marketing, and distribution capabilities. And the way that they applied this is that they were able to effectively eliminate industry barriers from high upfront costs and high customer acquisition costs. And a critical part of this competitive advantage was the presence of one of their co-founders, Jake Paul, who I'm sure you've heard of, media personality, extensive and very dedicated followers of, I think it's now over 70 million people. And, so this virality effect allowed Better to organically convert users to their real money gambling or gaming products and leverage their social channels and their talent networks that they built out, which allowed them to significantly decrease their CAC compared to their competitors. And, this advantage and their Better media arm, which is basically a build out of their talent that they had internally, complemented this strategy and created this unique flywheel effect. And this allowed them to grow their audience and develop brand affinity while being able to generate incremental revenue from Better media to Better gaming. So that virality, that, strong founder presence who has the network that they can tap into and leverage, that's a huge advantage that this company had and helped them to experience some of the hyper growth or exponential growth metrics, right? Or trends. And then another company, because of course, not everybody has that one person in their team or those advantages. Like I mentioned before, another, more attainable or achievable, a realistic thing is leveraging network effects. And so for that one, I'll look at another of our portfolio companies, CookUnity, and they're our direct chef to consumer marketplace. And they offer a pretty unique value proposition to both chefs and their consumers. And that's allowed them to scale their platform and create a sort of virtuous cycle. And through this positive feedback loop that they created, they have a higher number of chefs, which then leads to greater variety of dishes, which then attracts more subscribers to the platform. So it's this continuous cycle. And the increased demand leads to more meals sold on the platform and more earnings for the chef, which in turn attracts more chefs to return to the platform. So you can see how this cycle is very easy once you achieve scale to reproduce and turn on those network effects and create sort of like a self-sustaining growth engine that also in turn creates a defensibility for the platform. And then one other thing noticed, just because I mentioned CookUnity and now that I was thinking about it, another thing that benefited the company and helped to lead to their significant growth that they've experienced over the past 5 years, but more specifically the past 3 years since COVID, was market timing and market dynamics. The COVID-19 pandemic really fueled CookUnity's growth during 2020 because consumers were looking at different ways to live their lives. And part of their, the shifts that people made is they didn't want to go out. They didn't want to go to grocery stores. So of course you saw, Amazon, you saw Instacart, you saw all of those platforms skyrocket because people were ordering food in. And this benefited CookUnity because through CookUnity, you could get chef-curated, chef-prepared meals delivered at your house. And so, and even through, although COVID is waning right now, you can still see the positive effects of that on their growth model. And you saw that sort of spur the network effects and that flywheel, that value proposition flywheel that I talked about previously. So those are just, three things I would say, virality, network effects, and then market timing. Those are things that, we've seen play out in several of our portcos. And, the virality and the network effects were things that we recognized at the investment table prior to making the decision to invest in the companies. And then we just saw it, continue as we, as time moved on. And then the timing, of course, that just happenstance.
Yeah, I'd love to unpack the three of those a little bit more specifically.
Yeah.
So for virality, was Jake Paul the founder in the case with Better?
Yeah, he's a co-founder. So there's two founders, Joey Levy and Jake Paul. And Joey brought his experience from his previous startup, which was also in the betting space, the sports betting space, but it was more on this software and technology side. And then Jake Paul brought that element of go-to-market strategy for the company and created this sort of organic network effects with the company and virality that they were able to leverage and then grow pretty significantly and reach milestones faster than their competitors have, certainly, and then other companies could, by leveraging those. So he's a co-founder of the company, yes.
Yeah, I ask because obviously not every founder or co-founder has somebody like that in their back pocket.
Of course, yeah.
And of course, he screams virality, right? You put Jake Paul, Logan Paul, so many certain people in front of a company and people will just check it out. Now, what if you had been approached by a company like that and there'd been somebody like Jake Paul on board, or maybe a spokesperson or something, or somebody they're just partnering with content, but maybe not a founder, maybe not like embedded in the DNA of the company? How would that change the way you evaluate it from your point of view?
So, having a strong, broader network as a company is hugely important. Obviously, this was, like you said, a unique situation where the co-founder was this hyper public individual, right? But even if we see those hyper-public individuals on the board table, or on the board or on the cap table, which is something we would probably look into, if they're on the board, do they have a position in the company? If so, what's their exposure to the company? AKA, do they have skin in the game, right? So that would be important to us because if they do have skin in the game, they have, or a public declaration that there's a partnership between them and this company, or just a public presence announcing it, right? Then their identity as a personality, a media personality is tied to that company. So, it's not just monetary skin in the game, it's also like public perception skin in the game. So we would definitely look for one of those two things if there was like, a media personality, sports personality that was closely connected to the founding team or the company.
Yeah, and I should flag, and I'm sure you would probably agree with this, but correct me if I'm wrong. Just because a big name is attached does not necessarily mean success.
No, we've seen that. I mean, we see that time and time again, right? People, even sports personalities or media personalities, they start their own companies, and I think they don't always recognize the amount of hard work that goes into it. Or, it's a combination of multiple factors, right? That's just a broad strokes assumption there. But there's a lot that goes into starting a company and scaling a company, and just having that personality attached to it does not necessitate that company is going to be a success. However, what it does do is it gives more eyes on the company. And in today's day and age, having people's attention is incredibly valuable. And so having that natural distribution channel is the advantage that we saw with this company. But like you said, it depends on how closely tied into the company that person is, that individual or company or, whoever it is.
Yeah. So I want to move to the next thing, the next exponential growth characteristic, network effect. Is there a certain timeline you give for how long it like you'll give a company to start to attract the number of users that it wants, or to get a certain amount of adoption? I'm just thinking about, I have a friend that started a company. He's been trying to get users for a while. And it's like, at what point is it obvious, like this just isn't going to catch on? Or how do you kind of look at that?
Yeah, that's an intricate question, because again, it does depend on the type of company, right? If this is a SaaS company or a marketplace, of course, in order to scale marketplaces, you need the supply side and you need the demand side, right? And so, it's sort of this balance that has to be struck early on in the company, and recognizing the different pull factors to pull those two parties in and make it a cohesive environment. I wouldn't say that there's like a specific timeline. I think it's a number of factors, right? How much funding does that company have? So how long can they survive to, build up that network or that user base, right? Because they have to, at the end of the day, they have bills to pay. And so, building up a user base also takes capital. If it's a capital intensive business model, in the sense of you have to pay a lot for marketing and advertising, and so you have a high CAC, you have to be able to afford that. So certain companies, if it is a competitive space and therefore they have to have a higher CAC, it can take time to build up that user base unless they have some sort of virality or some competitive advantage in the marketplace where like their technology is just far superior to everyone else's out there, or they have a really well built out go-to-market strategy, or they're offering a product at a significantly lower price, which we don't always like to see because that's just a race to zero, right? But maybe they do have that, and then they start building up that network, and then or the user base, and by the time the competitors drop their prices, right, then they sort of have an advantage there. Are there high switching costs for users, right? So is that user more valuable? There's a number of factors that we never give like an exact timeline. Usually by the time that we enter a company, especially if it's a early stage company, we've already laid out certain KPIs with the founders that we expect to see them reach by the next funding round. And so, part of those metrics, if the company, one of their KPIs is users, right, we will identify that with them and figure out that attainable growth rate, right, with the addition of the capital that we just invested. So it just really depends on like how much the companies spend on their customers, how sticky are those customers, how big their sales team is, the sales cycle, like all of that comes to play into like how long it will take to grow your base to a mass population, which again depends on which stage you're into.
Yeah, so it sounds like you're not a big fan of the let's just, sell it for basically nothing strategy. What is it not viable to do the whole like we'll acquire the users at a very low price point and then raise it once they've all adopted, like Netflix has done or lots of other companies?
For sure, for sure. Yeah, there's definitely, that approach is used even by our own companies, right, internally to acquire the users first and then monetize the users later, right? We have a number of companies that do that, especially some of our fintech companies. So that's very attractive. It's for those companies, you do expect them to grow their user base more quickly if they're applying that methodology, just because we're basically investing to acquire customers in some of those cases. And so then you want to see a very clear path to monetization for those customers. And you want to see that you can get the value out of those customers. So, different factors or different questions come up if it's a company like that.
Yeah, I once worked for a media startup that did a great job acquiring users, but they didn't they had an app where you could consume their articles, but they hadn't built into the development infrastructure. They hadn't built in the ability to run programmatic advertising. So at no point could they have deployed advertising to monetize any of those people.
Right.
So that's a problem.
You have to think about it from day one. You can't think about it, 2 years down the line, right? You have to think about like, it's fine if you want to deploy a high CAC model and in the early stages and acquire as many customers as possible, or even low CAC and acquire as many customers as possible. But yeah, you have to build it into the business model and into the development process in the early stages, so that at the point at which you have that mass adoption, you can quickly turn on the monetization. And that may change as your customer base changes, right? But you have to be able to know, okay, my target market that I'm acquiring through this company, basically do like a market analysis on your customer base and then figure out, how much can we make off of these customers if we upsell them products or if we cross-sell them into different products, whatever it is. So yeah, I mean, it's definitely questions that pre-seed and seed stage companies should definitely be thinking of on the offset.
Even launching a podcast, I should in a couple of minutes, I should say, I'm loving this conversation. Olivia will be back after the break, and then pause for a second. And then 4 years from now, if I want to monetize this episode, I'd drop in a little mid-roll ad marker, which means that any ad I sell can run in this episode. But I'm not going to do that because our goal is not to make money. It's to help out startup founders.
Right. Well, you just did it. So in the future, you can always come back to it. So you're thinking ahead. It's never a bad thing.
That's great. This will be the first one with a break, and it's here.
Yeah.
And we're back. Great. I want to ask about the third network effect, or the third exponential growth characteristic, timing. I have read statistics that the number one predictor of a startup success is timing. And we see it all the time. Airbnb just happened to be around the 2008 housing crash, so people needed money. So there you go. Do the founders that come to you, are they aware typically of that timing factor? And do they come to you and say, like, here's why it's the right time? Or is that something that more you identify as an investor and you're keeping an eye on certain trends that maybe the startup founder isn't?
Yeah, I mean, typically, when it's big events like COVID, right? When it's big events like, the more recent downturn, when it's big events like the great financial crisis or the 2001 bubble, like those things, the founders that come out of those times always point to the timing as being incredibly important in the investors investing at that point in time. So it's always plays an important factor in the investment decision, and the founders do highlight it and are aware of it. With Cook Unity, we had already invested in the company, and that's why I said that for this company, we just benefited. The company benefited from, which you never want to say they benefited from COVID, but their growth, they were able to grow significantly during COVID because of the external factors. But yeah, I mean, it's why now is one of the questions that we always like to see founders answer during pitches to us, because as investors, we want to know, okay, well, why don't we just wait next year, right? When we see you achieve more traction, why is it right this second that you've come to us for your investment, for investments from us? So it's that question we do typically see during periods like right now, that answered. It's during like the mid periods, like probably next year, that we probably won't see founders answering that question as much on the offset, and we'll have to prompt them to think through that question and provide us with an answer. So it's more like if you see it in the news every single day, the founders are going to address it. But if not, we see a reduction in the amount of founders that come to us and say, okay, this is it, this is why, and it has to do with market dynamics. Yeah. So typically, yeah, I mean, I would say, especially during these days, the founders are coming to us and saying, this is an attractive time for you to invest in our company because of X, Y, and Z. And one of them is that, there's sort of been that shift in control back to the investors' hands, where investors are being more diligent and careful in how they deploy capital. And so that power dynamic has shifted a little bit, giving, investors an advantage. And beyond that, market dynamics have opened up interesting avenues and in software companies. So yeah, that was a little long-winded, but
no, it's helpful. You mentioned the word control, and I want to zero in on that for a second, because timing isn't really a thing you can control. And as a startup founder, right, I can control my virality to a degree, or even the network effect to a degree, right? There's so many things I can control. If I'm a startup founder, I see a problem that is based on timing. Like, would you discourage me from going after that because the times could change, or that maybe, we spent almost all of 2023 talking about an impending recession, and it didn't happen, right? Like, so if I'd been planning my whole business around there being a recession and then there's no recession, it's like, that's a problem. So how much of a factor should that be in the project that I launch?
Yeah, I mean, it's just like during COVID, right? Some companies benefited during COVID, and some companies really hurt a lot during COVID, especially if they were more public companies or serving the public sector in one-on-one environments. So, timing has different effects on different companies, and it depends what's going on in the broader macroeconomic environment. During this time, most startups are facing, like I said, that shift in power from founders controlling their valuations and how much they're raising and how quickly they can raise. That's shifted to the investor side, more towards the investor side, right? So that dynamic affects the whole. It's a systematic, issue in the market right now. It's affecting the whole marketplace. The only companies that are immune to that are the companies that have been able to achieve significant growth and profitability. That's what investors are looking for in any market, especially in markets like right now. So those companies, we've been able to see them raise at, up rounds compared to their peers who might have to be raising, if they have to raise right now, at, even rounds or slight uptick, maybe even down round from your own board and maybe socialize it externally. But a lot of times they like keeping that inside. So, I mean, this is like a more systemic thing that we're seeing right now that's affecting almost all companies. But if you're a company that hasn't been able to reach that growth and that profitability yet, there are, companies that come to us and we're like, maybe if you can hold off on fundraising right now, maybe you wait until the markets calm down a bit, right? So it depends on like, does the company have enough runway to support that? How much are they burning per month? How much is left in their bank? Like, can they survive waiting longer? Right? That plays a huge role in this. Or can they raise a bridge round internally before from their existing investors, if they have any, before raising an external round, which might make them suffer from a lower valuation than they want, right? So it's something affecting all businesses other than the ones that, then I wouldn't say that's not a blanket statement, right? But the companies that have experienced growth and have either a very clear path to profitability or have already reached profitability, those ones are less are more immune to the current market environment, or are able to still raise capital from the top tier VCs. But those younger companies, they definitely have to weigh, do they raise right now, or do they wait until maybe next year and see if the market, smooths out a bit. So it's a time, it always is a timing game, right? That's always a factor. And it just depends on the financial health of the company and what their growth expectations are, right? If they need capital now so that they can deploy it to attract users, or if they need to form certain partnerships and that requires them to make investments in their own technology to build it out, or grow their sales team to better attract those customer base. Sometimes those needs are more immediate. So, timing, they just have to at that point determine, all right, what's a fair price to price this at, or do we raise a convertible note and put a cap on it, right? So there's different forms of financing that they can raise. So it definitely comes to play though in the founder's decision.
Yeah, I know that many times, many guests we've had, many situations when I ask about, what works, what doesn't, there's a lot of "it depends" answers.
Yeah,
and
it is. It's like most. I know. I usually find that there's rarely an answer that's like, here you go, this is it, right? This is the answer you're looking for. There's a lot of like, especially because startups, they're also, they're all so unique in their own rights. And there are things that commonalities that you can find amongst them. But at the end of the day, each company has its own intricacies. And so what I may say for this one company may not apply to your company. So it is a...
But I feel like you really did zero in on a pretty basic thing, which is investors are looking for growth and profitability, or a clear path to profitability. So if I'm a startup founder and I can continue to grow or profit or have a clear path to profit without money or without investor money, I should just keep going. And when I need investor money to continue the growth and profitability, or that clear path, and I've demonstrated my ability to do those things already, then that could be a good recipe. Again, it depending, but it sounds like a pretty universal recipe for that secret sauce of, when is it time to go to an investor, and what do I need to have in order to entice them to invest? I think you nailed it right there.
For sure. Yeah, I mean, we saw during 2020, 2021, you saw those, well, even before that, right? We saw, it's almost been like whiplash. We saw, spend. We told investors, spend, or founders, spend the money, achieve the growth. Growth is what we want. Growth is your key priority. And then it was like, COVID is like, ooh, don't spend, cut your burn. You have to look at the bottom line, make sure that you have enough runway, extend that runway, extend it. And then it was like, oh, spend, you got to spend. What are you doing? Don't pull the brakes, spend. This is why we're investing. So I think it's definitely been difficult for the founders who have gone through those swings in the market. But I do think at the same token, I think especially the companies that are portfolio, who have come out from that time, they've come out a lot stronger, because, the companies that we see going through dips in the broader market, they often learn things that those companies who just what's the saying, rising tides lifts all ships. Those companies often struggle when then, if they've only been around when there's a bull market, right? And then they experience a bear market, they don't know how to act. So I think that, for the early stage companies that made it through that, that span of 4 years, I think they're better for it. But I do think that there was some whiplash there in terms of the expectations of investors that were communicated to founders. But the overarching is a core thing that Fuel always looks for in our investment opportunities, which especially are, I would say, Series A above companies, is growth along with profitability. That's always, even before COVID, this is something that we always paid attention to in our diligence process. And so it has to be something that is also paid very closely attention to by the founders early on. So, yeah.
Well, thank you for that beautiful transition into I wanted to kind of wrap up by asking about Fuel. The firm has a founder-focused, investor-driven approach. And you talked about it a little bit, but do you see a particular difference in the way that Fuel Venture Capital assesses potential investments versus maybe other VC firms?
Yeah. So, you mentioned our mantra, founder-focused, investor-driven, and we have our team is comprised of a lot of experts from the public markets with decades of combined experience in investment banking, et cetera, to the private markets. We have former founders on our team. And so, we're able to assess companies and work with the founders at a very intimate level. We're very active investors. So, the way we assess investment opportunities is like most VC firms, right? The founder plays a hugely important role in our investment decision. At the end of the day, you're investing in the child of this founder. And so, what we like to look for, I would say, with the founder is we like to see the founders who have a very deep knowledge of their entire business. And you see that in our hypergrowth companies. You see it in Community. You see it in Better. You see the founders, AxeLab, another one, Recarga Pay. These founders know every bit of their business. You ask them about the P&L, they know their P&L. You ask them about the recent, tech development that their team has built out, they can talk about that. You ask them about their customer base and what the sales team is focused on, they can answer it. They know everything about their business. And it's this sense of mastery of their business that I think separates the strongest founders from everybody else. So, this team and the founder are hugely important in our assessment of investment opportunities. And also our connection with that founder, because when VCs invest in companies, it's almost like a marriage, right? You're investing in this company for 5 years, right? 6 years, 7 years, 8 years. That's a long time. And we like to make sure that we're building a healthy and strong relationship with these founders. Because we play an active role in these companies and we're not passive investors, we want to make sure that we can collaboratively work together to the benefit of the company, which in turn benefits us. So we like to really get to know the team and the founders prior to making that ultimate investment decision. So that's a hugely important thing for us. And you'll hear other VCs talk about that, but we definitely take it to the next stage of, meeting with the team, meeting with the founders, going to dinners, coming to their offices, really having boots on the ground and interacting a lot with the team prior to that, making that investment decision. So that's definitely, I think one key factor of our firm, just knowing our philosophy.
I would ask then, if the founder is supposed to know everything, do you tend to lean more towards companies with co-founders?
Yeah, we let me think. That's a good question, and I should build that out. But I would say that definitely a majority of our companies do have co-founders, but I do want to add a note there. I'm not saying that the founder has to know everything. I'm saying that the founder has to be able to speak to broad-based most things in the company. Now, every founder, there's a flip side to that, which is we look for founders who have humility. You have to be able to recognize what you maybe have a gap in, right? What you might not be as strong in. And of course, that's why some founders bring in co-founders who can have complementary skill sets. But if they don't have a co-founder, they can just bring a team and a support system in around them through the board and through their investors to fill in those gaps. So we're not asking for the perfect golden founder, right? We recognize that everybody has their limits, and we just want to make sure that, or I think what separates the strongest founders in our portfolio is just that the founder lives, breathes, eats their company. And so they, by that very nature, they are so involved with every part of the company. And this changes as the company scales, but especially in the early days, they're so involved that they really can be their own advocate. And they can pull people in to talk to the specifics, but they can talk high level about their company, any part of their company. And it's just very different when you talk to those founders versus, others.
Wonderfully said. Well, I know I told you we'd be under 30 minutes. Of course, here we are over. You just had such a wealth of knowledge. We ended up going a little bit long, but this has been really insightful, and I appreciate your all the detail you've given and everything. To just, I guess, leave off just one final question. Where can people find you? I know they can go to fuelventurecapital.com if they want to learn more about Fuel VC, but do you want people to follow you on LinkedIn or Twitter or anything like that?
Yeah, we have a LinkedIn, same Fuel Venture Capital on LinkedIn. And we have a strong Instagram presence. We're across most social media. We don't hide or shy away. We always promote our companies and what we're doing inside Fuels VC. So definitely look Instagram, Facebook, LinkedIn, but our most active are LinkedIn and Instagram.
Fantastic. I will include links to all of those in the episode description. But again, great conversation. Olivia Gaudree, partner at Fuel Venture Capital and Vice President of Operations. Thanks so much for joining me on the Funding Blueprint, and happy investing. I hope that you see some exponential, what do I say? Exponentially
returns.
Growing, exponential returns. There we go. Thanks. Clearly, my voice is not the only thing going this morning. But best of luck, and thanks again for joining me.
Thank you so much, Cody. It's been a pleasure.
And that's a wrap for today's episode. Today's episode was edited by Sean Patel. If you're looking for a fantastic partner in any audio production or sound design or audio video editing needs, get in touch with Sean at seanpatel.com. Today's episode of The Funding Blueprint was produced by me, Cody Goff. You can get in touch with me at cody@academicpodcasts.com if you ever want to talk podcasts or anything else. I really appreciate you joining me today. We have a lot of really fantastic resources in the description of today's episode, so check that out wherever you're consuming this, YouTube, Spotify, Apple Podcasts, wherever. And again, that's where you can learn more about me, about Sean, about today's guests, and other resources we talked about in today's episode. For The Funding Blueprint, Unlocking Startup Success, I'm Cody Goff, and I hope that I will see you again, or hear you again, or you'll hear me again. I hope that you're here next week. I hope that we meet in some way next week. You know what I'm saying. I'm going to leave now. Okay, bye.